Hi, everyone. This is Jason Brack of Wall Street for Main Street. Welcome back for another Wall Street for Main Street podcast interview. We're recording this interview on Tuesday, June 10th, 2025. Today's special guest is a returning guest, the founder and chief market strategist at LaDuc Trading. In the past, she also ran a technology company. Samantha LaDuc, thank you for joining me again.
Thank you so much.
So, Samantha, like I said, we're recording this interview on Tuesday, June 10th, 2025. The S&P 500's rallied substantially. It's over 6,000 again. And for interest rates, the interest rates have stayed higher, I think, than President Trump and Scott Bessent want. The 30-year US Treasury was at 5% only a couple weeks ago. It's down to 4.94%. And the 10-year US Treasury is just under 4.5% when we're recording this interview. Now, the last time we talked, I think, was about 6 or 7 months ago, and you were telling the listeners that you think that the odds of a recession were fairly high in the second half of 2025. Do you still see that coming to fruition, or have you changed your views?
I have not. And actually, we talked originally back in June of 2024 and then did it again in December of 2024. And I still see, and I said the same thing in both times. And by the way, not prior to that had I ever made a recession call during this whole drama. So this is very, very specific to the second half of 2025. Now, Trump has come back and with his trade terrors in the early part of February through April, caused a great equity pullback of short duration. It was one of the fastest drawdowns in a quarter in history. In the same regard, we just had the very strong V-shaped recovery into near all-time highs with a VIX crush that was also historic. But that was because he came in on April 9th with policy intervention. And one of the things that I do is watch very carefully when under the Biden and Yellen Fed coordinated policy intervention, or now Trump Bessent policy intervention. Fed's not really playing ball with them, so got to leave Powell out of that triad. But yes, I still see that Trump did pull forward recession risk. Everyone was at the beginning of the year not saying anything about recession risk until Trump did push the higher tariffs and escalated both with headlines and through retaliatory type measures of escalating, stair-stepping higher tariffs, especially against China, which was baseline bet that that would be the target, as we discussed. But that all that did was pull forward recession risk. And then he came in and kind of unwound that on April 9th, saying, we're going to delay them for 90 days for rest of world until July 9th. And then we're going to delay China's until mid-August, basically August 10th. But it didn't change anything in my call for end-of-year weakness because of jobless claims increasing and yields rising, in large part because of this fiscal spending morass that has not gotten resolved and the debt servicing on the rising deficit, which is still front and center. They have not reconciled the bill. It's sitting in front of the Senate. Now there's pushback, right, with the Elon Musk kill Bill, quote unquote, kind of mantra that he's been pushing now because he had a fallout with Trump. But the baseline bet is that the jobless claims that have been stable, CPI that's been non-farm payrolls that has been stable, CPI that has been stable, I see percolating higher into the end of the year, and that increased combination of tariffs coming through with difficulties in the debt ceiling and tax cuts pushing through will form a little bit more of this fiscal tightening and increased job losses that will start to be a headwind for equities. So I still see it coming.
The Congressional Budget Office said that the budget deficit was only $1.8 trillion last year in 2024. But like you pointed out, with interest payments on the debt, they were $1.1 trillion last year in 2024. I don't see the math working where it says the budget deficit was $1.8 trillion, but the interest payments on the national debt were $1.1. I think the Congressional Budget Office has some bad math, some fuzzy math there. They're not counting some of the numbers. The numbers don't make sense that the government would only run a $700 billion budget deficit given the spending with the interest payments on the debt. The interest payments on the debt, like you said, are absolutely massive.
And it's interesting. The World Bank came out today, in fact, and cut the 2025 U.S. economic growth by 40%. Whether you believe it or not, The point is, they did come out and reduce the forecast from 2.3% to 1.4%. Now, what's interesting, they also, of course, ratcheted down 2026 growth forecast from 2% to 1.6%. But regardless, the focus on that announcement should have pushed yields lower, right? Falling, Fed rate cuts or falling global credit demand and economic growth contraction is typically a deflationary impulse that pulls yields lower and bonds higher. It didn't happen at all, right? We're not in a monetary dominance type of background anymore. We're in a fiscal dominance background. And this constant supply of Treasury bills, the shorter duration, not the longer duration notes and bonds, have been providing this QE by name or otherwise. Stealth, call it stealth QE, that's fine, but it's liquidity into the markets. And so this is also part and parcel of this transition from monetary dominance to fiscal dominance, where the 10-year yield no longer falls even on those types of headlines. It's very sticky. It'd be a good 100 basis points lower. It's not. So we're really in a situation where that complex right now of falling dollar with rising yields, and we've been entrenched kind of in that space since Trump came into office, and part of that's by design. That's by the way, I think part of that with the dollar falling is their policy initiatives. They want to have others demand fewer dollars because it's overvalued, and they want to lower it to help incentivize more companies to build in the U.S. and more companies who are here in the U.S. to export at an advantage because of a lower dollar. So they're working toward that goal. But yields Bessent has not been able to make good on his three legs of a table type of approach with lower dollar, lower yields, and lower energy costs. Well, lower energy costs are falling in large part because there's falling global oil demand. And part of that has been replacement value also in electric vehicles. 50% of ground transportation is solidly outside of the US. In the US, we have only maybe a 10% market share for EV. It's very small, very focused on brand, right? Like Tesla, because it's, Tesla. But for the rest of the world, it's about economies of scale and about pollution like in China, or mandates like in China, or cost savings for families, India and China. So I think here there's a little bit too much credit given to the administration in lowering the price of gas at the pump, when in fact it's falling global oil demand and falling dollars through de-dollarization and other trade policies. The one thing that they have failed to do is actually lower our interest rates. And I think they're going to have a really tough time doing that with inflation staying so sticky and prices rising against an economic contraction.
Well, that and other countries aren't going to go out of their way to help Trump if he's threatening to raise tariffs on them. So back and forth, tit for tat, threatening to raise tariffs, trade war, escalating things, our allies with Canada and others. You're not going to see members that are non-G7 countries, especially the last 3 years, Samantha, post-Russia sanctions, because honestly, there's bad policies from the White House and Congress with both political parties. You're just, these countries are just fed up. They see a math problem here with the budget deficits, the size of the national debt, the interest payments on the debt. And they're basically, I think at this point, they said, we're not going to do Trump or whoever's in the White House or whoever's controlling Congress any favors and subsidize the Treasury market and get yields down, because what's going to stop them from confiscating our treasuries or putting more sanctions on us or potentially freezing our assets like they did for Russia if they decide that they don't like something that we're doing?
Correct. Yeah, so there's not a lot of incentive. Now, I know right now that market is sentiment driven. The headlines of potential trade deals, potential peace deals, potential tax cut and debt ceiling deals. None of it's actually come to fruition. But the market loves to climb that wall of worry. They love to price in sentiment, and then they price out the fundamentals when it actually comes front and center. So we need these kind of macro disappointments to interrupt the bullish flows, because the market is really mechanically triggered by lots of bullish flows. But as it relates to the longevity of a market moving higher, we do need the fundamental and liquidity. And the liquidity right now that's been infused from the stimulus and monetary easing and fiscal spending from, post COVID into now, just fiscal spending is clearly being priced into the market because of, expectation. It's all gas, no brakes, right? Should it not follow through with this current plan, we'll actually get some price discovery, right? There'll be some reason why we can actually take a look at changes to this upward trajectory in equities because there'll be some tightening going on. But for right now, it's pricing in the expectation that the tax cuts will come forward. We'll go through, I should say, the trade deals of which we've got nothing in hand. We've had some minimum revenue from this, but there's much more interruption, especially in relationships with China, that has not been priced into supply chains either. So it's a lot of this expectation that all of it's going to go away. The taco man, right? Trump always chickens out, has also been priced into the market. This expectation that the Mag 7, with their very large balance sheet, and pricing power will continue. Also, forward earnings, 68% of which of the S&P 500 is from these Mag 7 focused AI future growth pulled forward type of plays that's helping keep the market elevated. So if any of that bad news was to come forth as it relates to, it's not as good as advertised, in addition to trades that sour, tariffs that obviously interrupt supply chains, as well as jobs. That whole combo deal is not being at all considered right now, but I'm seeing more signs. And it's not just 83% of CEOs are expecting a recession. That's the kind of wall of worry that the market climbs. But at the core of that is their ability to plan, or I should say their lack of ability to plan with the uncertainty around these trade policies and lack of, tax clarity. So I think right now we have climbed very well into this kind of melt up playbook before tariffs hit midsummer, and fall should be a little bit different.
Do you think that Trump was paying more attention to the S&P 500 and that that's one of the main reasons that he started to walk back the tariffs? Was he saw that basically the stock market was close to starting a bear market, the recession talk was echoing, and he just saw what a vicious feedback loop there of nonstop recession calls from analysts and banks coming out, and then the stock market, the major stock market indexes in the US starting to fall more and more below 20% into bear market territory, and that's why he started to walk back the tariffs and put a freeze on them?
I think he saw the credit markets suffering terribly. I made a call in February that credit stress was going to start coming in, and we went 200 basis points higher in high yield OAS, and that also froze the same time that bonds, the Treasury market, if you remember from post announcement on April 2nd, until Trump came in on April 9th. Bessent actually came in on a 10-year auction that day. And then about 15 minutes later, Trump came in with an announcement that he was going to delay the tariffs for 90 days. Prior to that, they had said, we're not going to intervene. We're not going to do policy intervention. We don't care what the market does. Let it fall, right? It was a feature, not a bug. Then they came in because they saw what happened. The 10-year yield went from 3.9 to 4.5% in 4.5 days, and stuff broke. So it wasn't basis trade unwind. It wasn't yen carry trade unwind. It wasn't a mechanism in the market that caught folks off sides. It was, in fact, the plumbing. So the liquidity within that very short period of time that triggered a rate of change that literally tanked both the treasuries and the credit markets and equities. They were all together now. That really preempted their move to say, okay, maybe we'll take a little pause here. And the market read that as they're not going to have tariffs. So the market does what it does. But it's all a monetary illusion. It's very much trying to avoid systemic stress is what the administration is supposed to do. So we're waiting right now, clearly, to not have this edge of default type of moment. In other words, you know what Bessent says, we're going to run out of money by July, August timeframe. We have to have the debt ceiling raised. They're not going to do fiscal austerity, let alone restructuring. Doge is dead on arrival, and that prompted the whole, I don't know what you want to call it, pissing contest between Musk and Trump of late. But the point is, they didn't get any relief from their spending and or fraud, waste, and abuse. So we did go very close on that early April to pushing into a sovereign, bond market auction tail risk. I don't want, it's kind of dancing to the edge of default, right? Well, we're going to do that dance probably again in mid-July, mid-August. Now, maybe they'll put in mechanisms, and I know Bessent is talking up SLR relief, which is about capitalization for banks, and it's also a way to stuff more bonds onto banks. But the issue isn't about the demand. It's not as much. Hold on. It's not as much about the demand, finding those who will buy treasuries. It's about the unending supply of treasuries. So right now,
it's a math problem between
it's a
supply
math
and
problem. Bingo. It's a math problem.
Well, and then also you have this is unusual. I don't think they expected this too, because when they announce potential trade deals, you don't hear them saying that as part of the trade deal that the allies are going to start buying a lot of long duration US Treasuries. In fact, it's the opposite, because didn't Japan, when they were talking about tariffs, Japan was saying we have problems with our currency, problems with our Japanese banks. They were talking about potentially selling more treasuries. So that's kind of the opposite, I think, of what Trump and Bessent were expecting.
But that's why they're pushing the Stablecoin Act with an oxymoron as a title, the Genius Act. That's why they're pushing the SLR relief onto banks, because they can push more bonds onto their balance sheets. So that compensates for potential any foreign demand of treasuries. But they're still demanding dollars and treasuries. I mean, we still have the reserve currency. We still have, for lack of better words, kind of, capital controls, which limits other countries from taking that torch. We can't pass the torch of reserve currency to someone else very easily, right? We still have a very liquid pool of assets. We still have
Let me try to summarize that, because you're talking very technical terms for listeners who are not familiar with all this. I think what Samantha means is that the dollar is still being used in trade settlements. So
yes,
the dollar is the world reserve currency. People are still using it in trade. What people are not doing, and what happened for decades, is China and Japan used to run trade surpluses and have massive foreign exchange reserves. They would recycle that into treasuries. Those days are over. So people are still using dollars, but the demand for treasuries at the central bank level, especially outside the G7, is just non-existent at this point compared to the past.
well, it's very changed. There's no question about that. But the collateral backing the dollar is still treasuries. So we're not going to remove that, right? So we will have also a test when, and not just de-dollarization can be very slow, doesn't have to be fast, but it's, in play. We'll have a test over time as our economy potentially slows down. But that's not, if they still demand as much of our assets and our currency and our treasuries. Right now, there are also policies afoot to limit foreign investment in U.S. assets and vice versa. So that was actually launched back in February. In fact, Trump had an executive order on February 22nd, which was to limit that two-way investment market, U.S. to China, China in the U.S., but it hasn't been implemented. Again, trade talks broke down, the markets broke down, and then they
weren't they also talking about taxing remittances? So
100%.
So
yes.
Immigrants who are legal or otherwise here in the United States who had bank accounts who are trying to send money outside to another foreign country, they were talking about taxing remittances, I think, too.
It's not just that, it's also the holdings. So if we have, 18 to 25% of, investment in the U.S. by foreign capital, by foreign owners, whether they be governments or individuals, that's a lot. So they're talking about taxing that. That's a huge change. Now, Bessent has talked about it, Trump has talked about it, and again, everything kind of quieted down as they wanted to focus on the trade deals, quote unquote. And then, of course, the tax, the reconciliation bill that passed House went to the Senate, and then it kind of has floundered there. But that's still a risk. Any attempt to remove Powell is a risk to bondholders. I should say bond vigilantes would, rise again. Any ability to and any follow through on the threat and the executive orders that have been drafted to tax foreign holdings on U.S. investments would also be met with a lot of volatility. So those things are still in the bush. And I don't think they're going to be dismantled. I think Trump wants to follow through with tariffs and with taxing of investments. We've had a tax treaty where there was no need to withhold or tax gains. Now they're talking about it as a revenue source. That's a risk to the market that the market's not pricing in.
Sounds like more bad policies from the White House and from Congress, more stagflate tax lie. I mean, like they're talking about raising the debt ceiling, by $5 trillion as part of this tax cut bill, something like that. I think it was initially they were talking about $5 trillion. It's both political parties. I've been here right outside of Washington, D.C. They stick so much garbage and corrupt stuff into all the bills, Samantha. It's kind of the average American, I don't think understands just how bad things are once these bills get passed, all the stuff that snuck into there. So yeah, Doge did highlight some fraud, but when it came time to actually do the spending cuts, you had like the neocon Republicans, and I don't like any of these guys. I don't like Mitch McConnell or Lindsey Graham or Crenshaw. I mean, these guys, they don't want to cut any spending. They want to spend more money on military and war. These guys are been in Congress, 10, 15, over a decade.
Too long.
Not changing. Yeah, they're not changing.
And that's part of the biggest issue is that we still have a situation where they're not making any fiscal restructuring deals to make the U.S. healthy again, and spending most don't care about, but debt is starting to materialize in ways that we don't really see, but we have more responsibility for. And also the government is crowding out the private sector. So half of credit right now issued, I should say right now, half of credit issued in the past year has come from US Treasuries. So that means investors need to allocate more and more dollars to finance the government rather than financing growth in the economy. So, through loans and consumers and such. So we're crowding that part of it out. We also have, of course, investment in speculative assets like Bitcoin instead of real people, projects, products. So we have a lot of off ramps for productive use of money and investment. And funding the government is not a productive use of our taxes, the waste that they use. So we have to figure out another way. But the only one who really kind of updates us on what's really happening is Representative Thomas Massey. Oh my goodness, his social media platform is quite strong, and he keeps us really, I would say,
he sticks to his principles. Yeah, and Trump's trying to get rid of him because he won't do a deal.
Yeah, exactly. And he's like, I'm a firm no, and there's nothing. Break this bill into 10. And then let's deal with it. Let's get the tax cuts, extended, but let's get rid of all this other pork. I mean, he's got a very practical way, but most don't have any power to change the status quo. As you said, you live and breathe all of that. So, but this is the market doesn't care, unfortunately, either. So there's that. They just care that there's going to be more money coming in that will find its way to leverage, right? Bank trading desks and lots of hedge funds. And basically it's easy money still, even if it's the cost of financing is higher, there's still an abundance of liquidity that backstops the market. And this is what still draws, the attention to everything's fine. We don't have to worry about it. But it's actually working on a fundamental myth that this money is real. It has to be paid back. Well, the market's really working on the myth that we don't have to pay this money back.
Well, I would say that you have the U.S.'s narrative on business television here, and the narrative from Congress, the Republicans in Congress and the Trump administration is one thing, and then you have the non-G7 central banks voting with their dollars on something entirely else. And that's why they've been buying, they've increased the gold tonnage purchases enormously post Russia sanctions, basically has doubled, and the pace hasn't really slowed down. Then you have Asian retail investor demand on the gold side too, that they're looking at a lot of the same financial issues that you described here with the US. So even though treasury yields are relatively high, you're not seeing as much demand in the past. Now, in terms of financial history, Samantha, is this really unusual for bond yields to be where they are and the dollar to be relatively weak? Because normally if bond yields were high, wouldn't that attract more capital to go in and buy bonds, drive down yields, and wouldn't that also start to strengthen the dollar?
If this was normal, but we really have this dominance background where they're trying to suppress volatility and yields. They're making lots of big efforts to do that. So until and unless we get a macro slew of bad data, and even a Fed cut isn't really going to do much, honestly. But if
We
we
need a
don't
Credit
get
Suisse, you think? A Credit Suisse type of event where a sizable bank has some serious issues?
Oh, there's no question. I mean, I'm nobody, but you listen to Gundlach, Dalio, Druckenmiller. um, I'm missing a few, but you know my point. They're all warning that this time really is different as it relates to losing control and having a tail risk in a bond auction within the next year or two at most. So it really does.
And
Go
And
ahead.
you don't see the Federal Reserve Bank then stepping in. You don't see Jerome Powell helping, wanting to help Trump. Because I heard, I mean, they had a meeting recently. I think that was the first meeting they've had in a very long time. I heard they weren't even speaking for a very long time, that they hated each other, that the go-between was Scott Bessent, and he was the one doing the meetings on Trump's behalf and relaying the information between Trump to Powell, that it was Bessent, the only person who would meet in person with Jerome Powell. So they actually had a meeting one in the last 2 weeks. So you don't think that Jerome Powell will actually reverse course and help Trump then, if there is a bond market issue like you described, and start to yield curve control, expand the Fed's balance sheet again with quantitative easing or debt monetization?
It's too expensive. It would be, I'm talking about inflationary. So they're kind of past that moment where any infusion, QE, would just trigger inflationary spikes. So that would be counterproductive. They really can't. So they've pulled a lot of levers over, since the great financial crisis, and they just kept pulling them. That's the big difference. They're
They kept
diminishing
rates too
rate of
low,
return.
and DC ran budget deficits and just thought that they could keep kicking the can down the road for years longer.
And they, by the way, they still are. I mean, that's exactly what they're doing with this particular reconciliation bill. There's no change from or any else. There's no fiscal restructuring to speak of. But we have the advantage where we still have reserve currency, best, dirty shirt in the pile type of thing, where we still have a very strong tech backdrop of not just AI, but services. We're not just talking about tariffs on goods, services are also at risk. Consumer is in great shape, relatively speaking, even if it's a money mirage. But we also have 30% of household wealth is tied to the stock market. So we now have even more impetus on the stock market is the economy. If the market falls or falters, the economy gets hit. Economy gets hit, and you know what happens with jobless claims rising and recession risk pulled forward. And then there's this retreat. And then, of course, typically in the past, they've come in with rate cuts and lots of fiscal spending and QE and or QE. This time, we're already at 4.5% in the 10-year, and it's staying very sticky. That thing gets and stays above 4.85%. It's going to push strongly higher, and that will create a very new backdrop against which companies and consumers have high difficulty in financing their costs. So, because the combination of higher refinancing with higher prices, I don't see this as anything short of resolvable without fiscal restructuring. And we don't have that. We don't have a chance of that. The best chance we've had was Doge, believe it or not, for at least some restraint. And then most recently, when they had that falling out, Musk and Trump, the Kill Bill
I,
theme or meme started to run, and there started to be some pushback, and now there's been a delay. But we don't have any chance of getting control of yields until we get control of fiscal spending. Full
Let's
stop.
let's not blame Musk and Trump here for. Let's blame Congress here because it's deal making and stuff like that. Congress doesn't want to cut. You have the neocon and the Rhino Republicans that are running both houses of Congress. They don't want spending cuts. They were actually, I think, in this bill, Samantha, they were talking about like military spending increases and hiding other stuff too. So I
Yeah,
mean,
no, no,
like,
that I agree with you. Oh no, this is completely not. I'm
so
just saying the
everyone's
funny
talking to the headlines like,
sidebar.
Musk, Trump headlines. I mean, the issue is Congress is just a disaster. They won't do
Oh no, I
anything
know,
right.
but it is very funny how they had a very public falling out. And the point is, we have none besides Massey and a few others that really are taking any personal responsibility for our debt. And
Well, why would you when you come to Congress and in under a decade you can get up to $10 million net worth if you keep your mouth shut and do deals?
yeah. And there's also this modern monetary theory, which is also corrupting, and the Bitcoin crypto asset speculation, which is also which is also corrupting, plus the grift, the great, age of grift right now, which includes Trump coin and all of this other nonsense. So we're really not in a
I heard he made a
backdrop.
billion. Yeah, I heard he made a billion. The Trump family made an extra $1 billion, I think, more than their real estate holdings in the last like 12 months.
And you wonder why bonds can't catch a bid.
Well, they catch in a bid because it's the math problem, like you said, with the interest payments on the debt, the pace of the national debt, and the foreigners are saying, look, there's no incentive for us to go and buy the treasuries because Trump might hit us with tariffs. Why should we go and buy the treasuries and help them get down yields when Congress is just going to spend more money, run out the budget deficits, and potentially they're looking at more tariffs or sanctions? So there's just not the incentive to subsidize and go and buy the treasuries because basically the countries that have bought the treasuries have been penalized. They've been targeted what with either the tariffs or sanctions or other stuff.
Plus, you've got Trump out, that this was heavier rhetoric, but he was saying you have to choose between U.S. and China. So don't be surprised also if the real economy continues to suffer, even as the stock market rises on fiscal spending and policy intervention and tariff relief or delays that we've all talked about, because the dollar is falling relative to this kind of monetary illusion that I talk about. The difference is that we have a situation where we're triggering a potential of much higher prices against economic contraction. So I'm focused on, Congress is the only one who can really save us as it relates to getting personally responsible for these rising deficits. But the reality is that we can get into a situation where we're in a recession and prices are still rising. Inflation is still a very strong core theme of a fiscal dominance monetary regime.
So that's
Higher interest,
stagflation then. So
it's
that's
stagflation, but it's more than that. Higher interest rates, as you know, trigger higher interest expense and refinancing costs, and all of that triggers larger fiscal deficits. I'm talking specifically also about this bill that then triggers more money printing, as you just referenced, direct monetization or otherwise. But that's inflationary. That is sustained inflationary pressure that leads to higher interest rates. So it's a closed loop. That's fiscal dominance in a nutshell. So we can't, we can't.
sounds like no good options, and there's definitely going to be pain, and there's no way of avoiding the pain that we finally run out of road here to kick the can with all the games that were played over the last 15 or 20 years. What where they lowered interest rates artificially low for so long. The Fed didn't. We didn't have mass amounts of inflation with the quantitative easing, although we did have asset price inflation, right, with stocks and home prices. But like a lot of the inflation that was created, the monetary inflation, it was either exported or ended up in shrinkflation with the consumer, that there wasn't like the type of stagflation and shrinkflation and stuff that the consumers experienced the last 5 to 7 years. That didn't happen over the last 15 to 20, but they don't have the options to do the same policies that they did after 2008.
And I think most in retail may not think of it this way, but the fixed income markets, what we're kind of talking about right here, right, with treasuries, is the second largest market in the world after currencies. So we're all macro traders. We all care about what happens with the dollar and yields. And right now, the dollar is falling while yields are rising. So this kind of brings me right back to that front and center issue of, is the US dancing to the edge of default? We have rising fiscal spending that continues to drive yields higher. We're in fiscal dominance, not monetary. We have tariffs that continue to magnify wealth inequality. The tax cuts also do the same. We have a situation now that was very, very apparent when we had the pullback in February through April, where money went home. There was an exodus of dollars invested by foreign entities that left, and that money is also staying home. So instead of coming into the US to invest, they're now going, hey, we can chase these yields elsewhere, but we also don't know if we really trust what's going on here with their government and Trump coin and fiscal spending extravaganza. But right now, that's the key that I'm watching, besides jobless claims, is how will Bessent finance these ever-rising fiscal spending bills, and how will rising rates compress, or when will they compress earnings multiples as the dollar and the economy falls? Right now, we're just at the beginning of that. I wasn't worried about Q1, Q2. I'm worried about Q3, Q4. And as rising rates compress earnings multiples, as the dollar falls, the economy will too.
It sounds like you just made the case with some of the summary that you just made that basically there's going to be very, very strong gold demand. Now, maybe they'll take breaks here and there from purchases, but overall, it sounds like the non-G7 central banks, Asian retail investors, foreign pension funds, they're going to be dollar cost averaging gold, maybe not necessarily a lot every single month, but they're going to be buying the dips here because they look at the math problem and the U.S. federal government finances, those budget deficits, interest payments on the debt, how quickly the national debt is growing. I mean, the Trump tax cuts, like how the debt ceiling was raised so much. And they're just saying, you know what? We can't deal with all this. We don't need to buy treasuries anymore. We own treasuries. Maybe we're going to net sell them, but we're going to start diversifying into gold. And I think the comments from the central banker, Samantha, like I just saw an article a couple of days ago from the central banker in Poland. He was talking about how they're underinvested with reserve assets in gold. And he's basically talking about how the central banks were drastically underinvested in diversifying away from dollars and treasuries, and that they need to increase other holdings in other things. And it seems like gold's going to be the main beneficiary of that.
Oh, definitely. Like, no question. Gold is also a great, collateral trade given all that's happening. You are very, very, I would say, ahead of the curve when it comes to the gold and precious metals industry as a whole. You saw this when we started talking back in June. It was actually March of 2024 that gold had finally kind of broken free and started to spike higher, and then silver followed in April. We talked in June, and you were convinced it was early innings of a gold run, and specifically focused on miners. You were spot on. I mean, they have continued to be the best trend trade, even better than NASDAQ. So
they've outperformed. The gold stocks, I think, have outperformed every single asset class. And it all comes to free cash flow and profit margins. I don't think the industry has had this type of free cash flow and profit margins in a long time. And I've been trying to look at some of the other industries that have free cash flow growth. And really, I think the gold stocks over the last 12 months or so, 12 to 18 months, they've had the most free cash flow growth.
No question, they have outperformed everything else, and there's a macro reason to stay long. We might have some short duration rotation out of gold and miners for a few weeks while money potentially rotates into equities. There's always money flow, right? There's always rotation, but then those are typically in a macro backdrop like we've outlined, in the initial part of this talk. There's a really good reason to buy them back up. Or stay long even through the dip, depending on the time frame and tolerance and such. I run an active, live trading room, so we're in and out of these much, much, much more aggressively. But the point is, it's a huge tell, obviously, for what QE is coming forth, how they're doing it, the macro troubles, the central bank settlement in gold outside of dollar, outside of the petrodollar. So we really are losing also that leverage as it relates to oil as our kind of balancing act with rest of world when they can settle their trade in gold and do less in internal combustion engines and migrate into electric vehicles. So we're losing a lot of that advantage. I think gold is going to absolutely stay in play and take on a strong role moving forward.
And the oil price at the bottom end of a trading range, what in the mid to low 60s or high 50s, if it goes back down there, that's really benefiting these gold mining companies. So they have gold
Yes.
prices way above $3,000 an ounce, unless the mining company has a cost control issue or the country starts issuing a new royalty tax or something like that. They should be minting money right now. They should have record profit margins. They
Yep.
should have enough free cash flow now to where all the good things about businesses in other industries that the gold miners have not had up until the last 12 months, they finally have options now with the free cash flow, whether that's like share buybacks or some type of dividend increase or reinvesting into the business, expanding an existing mine or spending on exploration or going out and buying mergers and acquisitions, some type of acquisition if they think the assets are cheap. So there should be enough free cash flow for all these things right now.
Oh, I love this highlight on falling energy prices because if you remember in June of last year when we last spoke, I said I see crude oil coming down into the end of this year, 2025, in the $60 to $40 handle. Nobody would believe me, but it is absolutely on its way. We've already hit 56. We've hit 56. We've bounced back up, but I still see it rolling over into a new range of 40 to 60, which greatly benefits the miners.
Yes, that would definitely. Now the risks are potentially like a royalty tax. So some of these governments could. We've seen in Mali in Africa, Barrick Gold had a mine in Mali confiscated for geopolitical risk. But the main issue, I think, is potentially a higher royalty tax for some of these governments in an emerging market with the finances. But you have certain countries where the policies with the last 12, 18, 24 months, especially Argentina, the US looks like it's headed towards pro mining. Canada and Australia are relatively safe. So for now, at least, those countries look like safe bets for the mining companies to operate the mine.
And that's why I'm still bullish precious metals. And we have just recently we talked a little bit about palladium and platinum. I want to get some time on that one because it's early. Still bearish bonds, I am. And I have not, even though I'm macro bearish, which is obviously that manifestation, right, of long gold and short bonds, it is not tactically bearish equities. As the dollar is also falling, it's helping that monetary illusion of stocks appearing stronger than they are, but it's also where the speculation flows. We still have lots of money in the system, and it's going to the path of least resistance. And there's a ton of mechanical buyers. Active funds are still kind of on the side, waiting to see what's going to happen with all the new policies that are promised or threatened for this summer. But for the most part, equities will have kind of a come to Jesus moment when we have another dance to the edge of default, like we did in early April, when credit markets spiked higher and bonds dumped in very, very short duration. And equities obviously careened over before Trump came out and did policy intervention. That's always what I look for. Tops are a process, bottoms are an event, and bottoms are the event of policy intervention.
It sounds like you described that the one asset class you want to stay away from on the long side as an investor is you're not trying to guess the bottom in the government bond market, whether that's Japanese bonds or US Treasuries, that you really don't want to play in that because of the warnings from the other investors that you mentioned, like Dalio, Gundlach, and Stanley
Diamond,
Druckenmiller. That
yeah.
so whether it's Japanese government bonds or U.S. Treasuries, European, that you're kind of staying away from government bonds. It seems like that's the asset class right now where there's the most risk with inflation and currency debasement risk, and that you think that the liquidity is going to benefit stocks and gold and commodities.
It already has, but you remember they have come out recently, Gundlach and Diamond, and Dalio and all those Druckenmiller. Anyway, they're playing in the short end of the curve. They're not buying longer duration, right? They don't trust that. So why should we? But also, I actually do have a bond short price target. So everything that I do as it relates to sharing with clients and working on different time frames and different cross asset correlations is that I can see a bear steepener in the 10-year, 2-year yield curve rising into about 90 basis points, so plus 90. This is also a call that I made back in December. And we rose into the positive territory. We got above zero back in September when Fed, September 18th, did their 50 basis point emergency rate cut. And we have been rising in that 10-year, 2-year yield curve. We made it all the way up to 65 basis points positive before retracing down to about 45. But the point is, I think bonds are a better buy once that yield curve has pushed into 90. So a plus 90 basis point 10 and 2-year yield curve, to me, is a much more likely bottom in the 10-year bond. So I can see yields moving higher. Long story short, I still see it.
And you talked about platinum and palladium. I'll just give my 2 cents on why I think there was a rally. So for the last like 2 or 3 years, the platinum and palladium price was actually below the cost of production for the majority of platinum and palladium producers. So they were barely surviving. I mean, like the miners were playing all sorts of games, but the demand for platinum and palladium was down because what the majority of it was auto cells, right? For catalytic converters, and auto cells were not doing well. Well, I think what has changed, Samantha, in the last I want to say 3 to 5 months, really since 2025 started, is my contacts in southern China and Hong Kong, because one of my friends is a business owner or in factories manufacturing there, and he goes back and forth. He was saying that the Chinese gold jewelry buyer in the retail investor sector, the high net worth, that they started moving some of their purchases for gold because the price has gone up so much in the premiums there in China. So in Hong Kong and in southern China, that they started buying more silver, they started buying more platinum and palladium. So that whether that's coins and bars or into the jewelry, that the jewelers in the past would have not used as much platinum and palladium, and now they're starting to substitute gold maybe, and they're starting to mix what platinum and palladium into the jewelry that the Chinese high net worth investor has been buying the last few months. So you're starting to see an increase in demand, and that's what's picking up the price. But a lot of the producers for platinum and palladium, it's only in 3 major countries. There's very few production outside of Russia, Zimbabwe, and South Africa. So the majority of platinum and palladium was not doing well and was in geopolitically unsafe countries.
Excellent overview. Thank you.
Yeah, so there's a world-class platinum for listeners out there. It's a base metal miner, Ivanhoe Mines, publicly traded. They're more known for their copper mines in Africa, but they actually found this world-class platinum and palladium mine with gold byproduct, and I think copper and nickel. And it's going to be the world's largest and lowest cost platinum and palladium mine. It's about to come online, I think, the first phase of it by the end of the year. The mine's called Platreef by Ivanhoe. Most of the mine will be mechanized. There's a huge Japanese corporation invested in it. I think even the Rothschild banking family owns an equity stake in it. It's a very, very large mine, and it's the first phase is almost done with construction, but they're going to be ramping the thing up for the next 6 or 7 years.
Interesting. Well, this is all part and parcel of commodities are getting a bid, right? As gold is being used as kind of this neutral FX reserve currency by other central banks and nations. That's a bet on US de-dollarization. As the dollar falls, commodities typically rise. Obviously, gold has lots and lots and lots of purposes. Silver, a little bit less, but more industrial. Platinum and palladium, you've just detailed. So we have that situation where even copper right now still looks very bullish, but not as much because of economic expansion, which is its traditional kind of value, but because, again, this monetary, situation of falling dollar is going to help likely these miners as well, not just miners of gold and silver, but of other.
Well, I think the copper might be needed unless we switch to graphene or some other type of material in the future, because I think one of the long-term trends, and you're a short-term trader, and I'm not really a short-term trader right now, but one of the long-term trends I think we're seeing, and part of the Trump's policies with the trade war and tariffs and stuff is because of this, is we have a technology arms race. We have a Cold War, and you have the US and China, the technology companies, the military and defense in both countries, they're ramping up capital expenditures on artificial intelligence software, data centers, drones, robots, quantum computing. They're spending, all the tech companies or the military and these governments are committing to spending absolutely insane amounts of money. I think the US tech companies spent over $200 billion. They're projected to spend, I think, in 2025 alone on all these different types of things. So there's clearly a Cold War 2.0 and a technology arms race, and the Trump policies with his tariffs and the trade war fit into that.
I like the technology arms race as a reason for the season, also for silver, right? They go part and parcel with it. So you're talking more about the infrastructure build out for this tech arms race, as well as more, AI, more.
Well, I think the silver has it. There's been actually, I was looking at projections. There was a huge actually demand spike for solar panels that surprised the market because it was way above projections for China and India for solar panels. There was a lot more silver stockpiled by those two countries to manufacture solar panels than the market was expecting. But you also have investors, because of the high price of gold, they've been looking at the gold to silver ratio, Samantha. I mean, we got a record high for the gold to silver ratio. So if you're a metals ratio investor, you're going to say, hey, wait a second, the gold price is way over $3,000 an ounce and silver is like 25 bucks. I'm going to start diversifying some of the capital that I was going to buy gold. I'm going to start buying some silver now. And I think that's what's been happening lately.
You mentioned the solar, which is interesting because, as you know, I run a trading desk with 10 subject matter experts, and Jeffrey Fruvet is very hot and heavy about solar, specifically FSLR, and only recently because of its dominance in sodium batteries. We were talking about silver and the industrial use of, and the positioning in the U.S., where we will start to move into that again. It has not been in play until just recently, but we were talking about FSLR. But when you say I'm a short-term trader, so for example, CCJ, we talked about Cameco in our last talk, and uranium in general. These were recommended. These were new trend longs back in November of 2020, and it's 7 times since. And this is a big theme as far as nuclear renaissance. Did I expect it was going to be feeding into this AI infrastructure build out? Absolutely not. But it is now.
Well,
right?
yeah, the last 2 years have been just crazy. Two and a half years with the gains. I mean, I was listening to a technology podcast, and that's not my expertise, as you know, I'm finance. But I've been learning the artificial intelligence the last like 10 or 11 months and listening to tech podcasts. And this former Google employee wrote a book on artificial intelligence. He was talking about how like the software is improving enormously every 6 months. And like it's Jevons paradox. So for listeners out there, go and ask your artificial intelligence software to give you like an explanation of Jevons paradox with energy usage. And as the software gets cheaper and better and improves, more businesses in other industries adopt it. And that will overall increase energy and electricity usage as more businesses adopt the software that uses more energy and electricity.
Yep. Jeffrey talks about that as well.
That's something that like the people are saying like this AI bubble is done. They don't really understand. So like that's why you're seeing the headline, Samantha, with all the technology companies, and they're just scrambling. So all these data centers, whether it's the one in Texas, the Stargate one, Stargate AI, they're trying to secure natural gas pipelines, or it's nuclear power. So they're trying to lock up as much reliable power as possible. And I guess the solar panels, what will be part of the mix here. They'll put some solar panels on, but that's not going to be the main source of energy and electricity.
No, but it's still a theme that has been beaten to death, much like miners, right? So it has its season, and it's coming back into, let's just say, I think a future talk. Next year we'll talk about.
Well, it's cycles, right? So if something's in a
Yes.
bear market, like I said, commodities are easy with this because if the industry is producing, the suppliers, the commodity selling below the cost, I mean, the industry is not going to survive. At some point, the cycle is going to have to turn, whether that's platinum and palladium. What platinum and palladium were stuck below $1,000 each. The industry was losing tons of money mining it. Eventually, you knew the cycle was going to have to turn. Uranium was in a bear market like that for many, many years. You knew that eventually the cycle was going to have to turn for uranium too. For years, what a lot of those, it was cheaper for Cameco, which was a winning stock pick for me too. It's cheaper for Cameco to not mine any uranium and to just go onto the market like a hedge fund and buy like uranium that was above ground already and resell it to a utility company. I mean, that wasn't their business, but the supply and demand was that screwed up in the bear market for that long that it was just cheaper for them to be hedge fund managers and buy uranium above ground from a Japanese utility company that had a stockpile and resell it to another one.
A little lazy, but effective.
Well, if
Well,
you're a uranium miner, that's not your business. That just shows that it's a bear market and they did what they had to do to
that's right.
survive. Yeah.
Mhm.
So, but like eventually the cycle. My point though was the cycle is going to turn, right? Because you can't have all the suppliers losing money hand over fist and going bankrupt unless like there's not going to be a market for the commodity or something anymore.
Well, this is all feeding into, macro trends from the gold and silver ramp into what's next for commodities and its relationship with dollar and yields and the economy. And right now, there's an enormous focus, obviously, on the tech driving this show, but it's a lot of forward growth pulled way, 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 way ahead into these earnings estimates. So, meeting, I think, some more. We'll need some more data, basically.
Let me just say that I think it's a safer bet rather than telling you which technology company is going to win artificial intelligence or who's going to benefit the most or which industry. I think it's a safer bet, Samantha, to say natural gas prices. There's going to be more demand for natural gas and uranium. That these power companies, the utilities, the uranium miners, the companies that are innovating with next generation nuclear power, the natural gas pipeline companies that are moving the natural gas from the Permian Basin or somewhere else to a data center, or the company that's generating the power there, or the natural gas producers. Those are the ones who are going to benefit rather than telling you which software company is going to win the artificial intelligence software race.
Well, this is part of it. What I was also going to say was we will have to see also what China comes up with next because they're not wallflowers when it comes to, competing on this AI tech stage. They've already come in and deep sixed the semis back in early January, inauguration day, actually, where DeepSeek actually kind of made the headlines and airwaves and ended up by the end of the weekend becoming the number one app downloaded because it's free. It totally avoided export controls, right? So the fact that I'm kind of focused on how the US market is excited about this AI ecosystem and all that it surveys, when in fact there are a lot of competitors coming out with China being among the best as it relates to dominating a space. It has not stepped on toes of US AI tech dominance until the inauguration of Trump on January 20th. So, and soon after, obviously, the result was folks were scrambling. Is this a great investment idea to have AI if we can now get it free? So we climbed back on that wall and said, yeah, we're fine. It's the US after all. Never bet against the US. But in reality, China has a lot in focus on not just the tech, the science, and new energy sources that are very compelling in competition with the US and might be a very big surprise as far as bingo card. Don't rule them out for end of year and beginning of next, especially if Trump is pursuing his very aggressive trade tariff policy with them.
Well, I think what a lot of investors and people, Wall Street that are analysts that are covering artificial intelligence software, are just starting to figure this out because I just saw a video from Morgan Stanley talk about this. The investment bank put out a video with research. The software from the artificial intelligence is going to start to go in as an operating system into the drones that are improving, into the humanoid robots, all these different types of robots. Manufacturing for different industries, whether it's auto or even restaurant worker robots, because there's a fast casual burger chain called Burger Bots out now that's better, that makes a hamburger in a record amount of time compared to humans. So you're going to start to see the software as it gets better and cheaper applied into drones and robots. And China's really, really good at manufacturing really high quality stuff. And China has a huge advantage, whether it's Unitree with the robotics. They're mass manufacturing better robots and drones than the US right now.
It's not just drones. I mean, they're number one in manufacturing from cars to electronics to textiles. They're number one in steel and cement production. They're number one in
well, that's just related. I'm adding in the knock-on effects though of the artificial intelligence software because the software is going to go into the robots and the drones.
And they're number one in rare earths and batteries and solar and EV global sales. The point is, I think that Trump and Bessent might very much underestimate China's power in creating a very large moat, not just in physical dominance, but also in tech dominance.
Well, I think Trump is taking advice from the 5 or 6 people in Silicon Valley. They're the PayPal mafia. So that's Elon Musk and Peter Thiel and Mark Andreessen and David Sachs and 1 or 2 other big tech guys that are billionaires. That's who is giving him the policy advice. So the
But even Jensen has said, Huawei is doing it, is absolutely not needing NVIDIA, et cetera, et cetera. They have got the tech. And if they don't have it, they're going to very, very soon. So I think, little warning signals have been sent out. DeepSeek, the disruptor, but I think U.S. investors aren't pricing that in. So there's another risk in the bush besides what we're going to get with tariffs and trade wars, and tax cuts and all that. I think that's another underappreciated risk. As the dollar continues to fall into prosperity, apparently, we have China as a very big tech dominance player that the market doesn't see yet.
But we said earlier in the interview, I can't remember if we said on the recording or before we started recording, but we said that we both agreed that Trump and Bessent both want a weaker dollar. And
Yeah.
honestly, I think like the economists that are giving the policy advice to whether it's the White House or Congress, these economists, whether it's Keynesian or MMT or monetarist, they all seem to, their policy is they want a weaker currency. But are you surprised though that like the yields are still rising? So that's kind of, I think that's what they didn't expect. I think they thought that they could convince people to buy bonds, they could get the yields down and get the U.S. national debt refinanced. So they're kind of getting only part of what they wanted. What with the weaker dollar, they're not getting lower bond yields to refinance.
Correct, and they're not going to, for all the reasons we just talked about, from the fiscal dominance to the increased spending, and there is not a chance that we're going to get lower yields without recession, and or Bessent says growing our way out of it, but that's not reasonable right now given the backdrop. And I think there's really just this kind of promised MAGA American isolationist policies that Trump has are going to be more short-term pain for potential long-term gain, but part of that is going to be inflationary, which also pulls yields higher. And I don't mean the rate of change in inflation that's falling right now. CPI is 2.9% year over year. I'm talking about this compounding inflation that we all have on Main Street, not Wall Street, which is up 30% since COVID. So that's the stickiness in the prices that are also very underreported or unbelievable when they are reported. BLS as well, right? GDP, all that. We have to kind of we've got to take it with a grain of salt. We can tell that inflation is not coming down as it relates to Main Street. So yields are going to stay sticky. Prices are going to stay sticky. Oil's no longer an inflation hedge like it used to be. We really do have Bessent talking about stuffing bonds into stablecoin acts and and bank balance sheets, and reserve status. Reserve currency will still incentivize foreign holding of dollar, which is collateralized with treasuries. But the reality is that the spending is the problem. The supply is the problem, more so than even the demand. So yields are not coming down. Without a recession.
So as we wrap up here, since this is an investing podcast, let me ask you, sounds like you like gold companies still. Are there any other sectors or industries where you think are undervalued, where you think could rally for the rest of 2025 with free cash flow growth or dividend growth, maybe besides gold stocks?
Oh, I'm much more active. So there are, I chase swing and trend time frame. The trend portfolio, which is what we were talking about with uranium, for example. Gold didn't really even make it back in there until last spring of 2024, and it's still contender, right? There are amazing opportunities in miners still, but there, as far as a sector theme, I go in and out of them depending on the strength of the company and where we're at in money flow. Right, I'm also very active on the swing trading time frame. Right now we have this wonderful pullback that created a lot of springboard support for semis and other plays, but I see them coming in and hitting their head very, very soon. We're not quite there yet, but I can see a situation where we start to roll over in July, August, flatten out, and then roll over into the end of the year, which would be probably the timing really, really well with my recession risk pulled forward call that I made last time we talked. So I'm still looking at tactically being bullish, macro bearish will all come together this summer and will start to roll over into the end of the year. And it will start to pull that same type of fear in recession odds that we had at the bottom of April, right? Where Yardini had changed his tune and and I'm like all of the big names had Apollo said there was a 90% chance of recession, et cetera, et cetera. So they'll all come out of the woodwork again, but not before Q3.
It's tough to say if there will be an official recession in the next couple quarters because I mean, like, it seems like there's going to be enormous pressure politically to not name an official recession, even if it's really obvious.
Oh, they're always named after the fact, but the recession risk gets pulled forward like we had in April. So that's what I'm talking about is BlackRock had even said we were in a recession back in April. I don't think so. But the point is that recession risk gets pulled forward and then it doesn't stop because jobless claims will start to percolate higher, because yields will start to push higher before getting a deflation impulse. So I think that's what I'm looking for still into the end of the year. And of course, they can do more policy intervention. They can try QE, but that's inflationary. So I'm right now still kind of stuck on that. I will be confirmed or it will be completely negated, but not until the end of the year.
Well, I really enjoyed our discussion today. I want to thank you so much for your time. It just sounds like more currency devaluation. I call it stagflate tax lie. So more stagflate tax lie. I mean, maybe the levers are going to change a little bit. The policies are going to change a little bit, but the main themes are out of DC that they're not actually doing sane policies right now. And as long as this continues, Samantha, I mean, we're just going to see now a lot of the normal buyers of treasuries in the past are not large buyers of treasuries anymore. And they seem, at least what they're saying publicly and what they're doing with their dollars, they're buying gold.
And we still have Bank of Japan. You know, if they lose their yield suppression power, we can also see a confidence crisis triggered, carry trade unwind risk. And that is something that is also something that I don't think we have to worry about right now, but it's coming full circle where we had this risk back in July, August of 2024, and you combine that with a basis trade unwind. And this is going to be problematic as we go into the end of the year. But I think right now we've got the summer doldrums and things underneath the surface are still focused on getting this reconciliation bill passed and some semblance of trade deals. And then I wouldn't be surprised at all if Fed starts talking about cutting in September just to kind of keep that normalization in play. But for right now, we still don't have even resolution as it relates to Bank of Japan and what they're going to do in managing their inflation.
It's a mess. I mean, finally, like, Japan seems to have hit the limits too. So it looks like all these major governments here, with the debt monetization, the budget deficits. I mean, none of these governments are cutting back. I saw an interesting statistic. I think during the pandemic, over like a 3 or 4 year span, I think about $18 trillion worth of government debt was issued just in the last 3 or 4 years. Some absolutely ridiculously high number. So it wasn't just the US, it was like all these G7 governments. It was 18 trillions worth of government debt was sold. It's absolutely insane.
It's bond volatility waiting to happen.
Well, I'm not a bond investor. I'm not a bond fund manager. I didn't hire
We're all
a.
bond traders.
I hope not because some of them blew up their bond funds. I mean, like, I know some of them lost like 30-40% of their one of them was advertising on the front page of his website that it was a safe 8% yield with US Treasuries, long duration US Treasuries and junk bonds mixed in there not too long ago.
Well, I think we're all bond traders in the in the concept that yields will dollar makes the weather and its rate of change determines the severity. I say that about both dollar and yields. And when we see yields percolate higher, too high or too low, the market loses its balance. So that's what I mean by we're all bond traders. We're really focused on yields moving forward.
Oh, I was just thinking that in the past, like with war bonds, when a government went to war, they would force people like to buy their war bonds, and then they would intentionally destroy what the value of the currency and inflate the debt away. So hopefully that doesn't happen. But it sounds like Bessent's trying to do some of
Oh,
that stuff
yes.
with the banks.
Yes. Agree. That's exactly, but a little bit of that will quickly I think, be tested very, very soon. Debt is what's fueled America's exceptionalism. There's no question. And I really believe the interest on that debt will trigger its unwind.
Well, yeah, I think the main theme here is that all these major governments here all have huge government budget deficits and too much debt crisis issue here, whether it's Japan, European Union, United Kingdom, US. Even China has a debt problem because like they hardly had any government bonds or private credit, I think, prior to 2007. Then their economy went up to 50 trillion of credit, the fastest in history from 2007 to about 2020.
And I know most people aren't looking at it right now, but what if this tax bill doesn't pass? It's also a risk, or I should say, the tax cut bill, the debt ceiling, all of that yields, either way, yields look destined to rise, whether they pass it or not. And we have been there before where government has gone into under Trump, has gone into a shutdown risk. It happened under Trump 1.0. So there's also the issue of foreign money, going home, and foreign withholding of tax, that if that passes, will just mean that money goes home faster.
Maybe it's just me because I'm so close here to the Capitol building. I'm like 20 minutes out with traffic from the Capitol building here in DC. But it just seems like every time there's a debt ceiling issue, Samantha, the last like 7 to 10 years, it's almost like a hostage crisis. I mean, both parties. It's just.
That's
I
that's
wish.
sad, but that's a really good way of putting it.
Yeah, well, I mean, both parties want to stick it to each other. They want to go to the press and then say like,
Yeah.
this other party's evil and they kill babies and all they do is
Mm.
lie and they're evil.
Well,
It's
they all lie in the same category of politicians and Wall Street. It's really, really, it's tough to trust them. But we will find out, right? This summer, while everyone's on the beach, when we come back, we will find out if we actually have a reconciliation bill that doesn't explode deficits and interest costs. Color me skeptical. In the meantime, enjoy your summer.
Yeah, and this could be a golden summer. I mean, David Einhorn, I think, said in his newest investor letter, he said in the not too distant future we could see gold prices around 4,000. So we might see a little
Yes.
break here, but we're
Yeah.
just seeing the data. Whether it's the People's Bank of China, other central banks, they're still buying 7 months in a row, dollar cost averaging, more gold, more gold, more gold. So the Swiss gold refiners are announcing that like they're running the refineries 24/7, 365, and having some trouble sourcing the gold to melt it down and what they're buying it from the US because Americans aren't buying bullion. So they're buying it from bullion dealers who are going bankrupt and they're remelting it into 4 9 kilobars and selling it at premium into Asia.
It's funny. China has a mandate for electric vehicles. Ground transportation is a big cause of their pollution, and also they wanted to wean themselves from the petrodollar. So they really pushed forward and subsidized, electric vehicles, and to the point where their mandate was to be 50% by, year 2030. They're way ahead of that mandate. I just saw a headline where US has increased EV adoption to under 10% versus China's 50%. And I think the same way about gold, right? There's just the rest of the world understands its value, and we don't, relatively speaking, because we are the reserve currency. It makes us fat, dumb, and happy. But for the most part, it does make it more valuable now because things have changed as it relates to, again, a global bond volatility event in the near future. So Gundlach also said 4,000, by the way, along with David Einhorn. So yeah, folks, very, very smart macro folks are bullish gold and bearish bonds for really good reasons.
And I think that's a macro trade. So unless we start to see these non G7 central banks stop buying gold and start buying US Treasuries, I mean, like the pace is just going to continue. Last year, 2024, they bought 1,000 tons of the non G7 central banks bought around 1,000 tons, according to the World Gold Council, of gold tonnage. And that's about 35-40% of the annual mine supply. So that's all going right to the central banks. The refiners in Switzerland have to refine the gold. And then it's going to central bank vaults. So it's the new reserve asset. So that's the major trade. A
And
huge.
and silver's in a supply deficit as well. So it's going to keep the fundamental bid in precious metals. long
Well,
story short.
no surprise for silver because for the bear market, Samantha, the majority of the time silver was at or below the production cost. So you had all these silver miners. Pan American Silver was one. And just to survive the bear market, they had to go and buy gold mines and copper mines, mostly gold mines, a mix of gold and copper mines. And they had to diversify away from silver just to survive. So they shut down the silver mines or they weren't investing in them for like 7 to 10 years, and they had to wait for the silver price to rise. And now you're starting to see the companies that have good silver assets like Pan American Silver, they're either going out and doing acquisitions or they're starting to debate bringing the silver mines back online.
Interesting. Yeah, well, it's been a good trade. I think it will continue to be.
I want to thank you so much for your time today. If my listeners want to check out LaDuc Trading, how do they do so?
I run a financial research firm, LaDucTrading.com, LADUC trading.com. I've got 10 subject matter experts from macro to micro, live trading rooms, portfolios across macro again, and different time frames, chase swing trend, fixed, oh my goodness, all assets. So we really come together and support clients and navigate all of these macro event risks and decide whether or not it is worthy of our time and money to be invested, and when it's not. And right now we definitely have a macro bearish bent but a tactically bullish one, and we'll see potentially that change this summer when I think we're going to start to get a little bit more volatility and weakness into the end of the year, and we'll see if that recession risk pulled forward happens again. But that's my baseline bet.